BigBear.ai is one of the most popular AI stocks in the market right now. Of course, contributing to the popularity is the relatively low share price. It's trading at less than $10 per share. And if you notice, the stocks that tend to get popular with retail investors are the ones that trade at relatively inexpensive prices. So in this video, I'm going to dive deeper into this company, analyze the latest developments so you can understand what's going on and make a more informed decision.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So, in its latest quarterly meeting with Wall Street analysts, Big Bear's management team highlighted some of the difficulties they're having in the business. Like all federal contractors, they are navigating the government shutdown, which has recently ended, thankfully. Importantly, over 80% of their government contract work has been deemed accepted and mission essential, including their work for the Department of War and Department of Homeland Security. So the other side of that, of course, is that 20% has not been deemed essential, and that part of the business is under threat to be canceled or just paused. And of course, earlier in the year, BigBear.ai also lost some contracts because of the cost cutting. Remember when President Donald Trump and Elon Musk were best friends and they were going around cutting government spending? One of the areas they cut government spending on was in government contracts with institutions and private companies like BigBear.ai that contract with the federal government for consulting and other services. So they've already lost some government business, and now during the shutdown, more of their business was disrupted because of those. So that said, parts of contracts, mostly for the intelligence community, have been temporarily paused and have resulted in some revenue and personnel disruption. And of course, this is a bigger deal for a company like BigBear.ai, which is losing a lot of money on the bottom line already, even with the government contracts going as expected. They're still losing money on the bottom line. And so that is even worsened when these deals are paused. So at the end of the third quarter, they have total cash and investments of $715 million, which includes $457 million of cash and $258 million of held maturity securities. So these are cash and short-term investments that the company, if it's not in cash, they can quickly turn it into cash. So overall, they've got about $715 million of cash. And that's important because, like I mentioned earlier, they're losing money on the bottom line. So they need this cash to support the business until they hit the next milestone, or until they can reach a level where the business is self-sustainable, which right now it's not self-sustainable, and then they can be a less risky business, because at least they've hit that inflection point when they don't need to keep coming to investors and asking for more money. But for now, they need to keep going to investors to ask for more money. And during the third quarter, during their at the market facilities, they raised approximately $337 million in exchange for the sale of 65 million shares of their common stock at an average price of $5.18 per share. So this is the company needing money, and they view their stock price, like I do, as being overvalued. In my opinion, that's what I view as. I don't think the management team necessarily will admit that they see their stock price as overvalued. But when a company like BigBear.ai, which has a choice when they raise capital to either borrow money or sell their stock, companies that view their stock price as being overvalued are more likely to sell shares of stock rather than borrow money, and vice versa. If companies feel like their shares are undervalued, they would rather go out and buy back shares rather than sell and raise capital. So whenever you see companies selling stock to raise capital, it's usually not a good sign. There's rarely a case where I see where a company is selling stock and that's a good sign for investors. I've rarely seen that kind of situation. Usually this happens when management teams are desperate for money, or it happens when management teams feel like their stock is overvalued. it's also prudent for management teams to raise capital before they need it desperately, because then they won't be able to raise as much money. The share price will be much lower. So this is, in my opinion, a prudent move by the management team, seeing this share price at $5 or over $5 per share, and anything above $5, in my opinion, I see it as being overvalued for this business at its current state. It has great prospects. It has huge upside in the future if they can execute on their plan, which they have not been able to do up until this point. But if they execute and they deliver and they capitalize on the opportunity in artificial intelligence and the categories they're operating inside, it could be a great return on investment for shareholders. But up until this point, it's been mostly increasing based on popularity and less based on improvements in the company's financial performance. So third quarter revenue came in at 33.1 million, which was a decrease of 8.4 million year over year, which was primarily driven by lower volume on Army programs. So BigBear.ai has found it challenging to generate revenue growth, even after they've made several acquisitions. And those acquisitions add to the company's revenue because you're just acquiring a company and all their sales become your sales. And even after accounting for all the sales from all the companies they've acquired, third quarter revenue was still down 8.4 million year over year. Now, the most recent acquisition of Ask Sage, those results, those figures are not included in the company's third quarter revenue. So those figures are still that deal is still being finalized. And a little bit later, you'll start to see the impact on the company's revenues. Also, gross profit margins decreased year over year. Gross margin for the third quarter was 22.4% versus 25.9%, primarily due to certain higher margin programs in the third quarter of 2024 that were not repeated in the third quarter of 2025. So that's more bad news for BigBear.ai stock investors. Last year in the third quarter, they had certain programs and certain deals that were generating much better profit margins that they were not able to replace this year. So that contract ended and it didn't get renewed, which is a double dose of bad news for BigBear.ai stock investors. So you see the company is facing headwinds, and of course the opportunity in the long term is huge, of course, with artificial intelligence. But BigBear.ai, as evidenced by, this recently completed quarter, was yet another sign of decreasing revenue. And you can go back the last 3 years, and their business has been choppy. Sometimes they deliver revenue growth, sometimes they don't. They organically find it challenging to generate revenue growth, so they make acquisitions thinking that will boost sales longer term. But after the initial boost, it doesn't persist. And so for all those reasons, I've been warning investors about this company. At the current market price of $5.82, I see it as being overvalued. The intrinsic value per share I calculated for BigBear.ai is $1.14. So anything at these levels looks overvalued for BigBear.ai. And I will reiterate that I do not have this stock rated as a buy. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.